Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
I'm going to start us off. If I could ask everyone to begin to just introduce yourself, your company, and thoughts about and reflect upon the moment that we have here and some of the concepts that Shimon was talking about. We'll start off with that, and if we could, we'll start with Justin.
Yeah. Hello. Hi, I'm Justin Pelsinger, COO of Charney Companies. We're a fully integrated full-service real estate firm based in New York City. We're currently building over 3,000 units around the city, most of them in Brooklyn and Queens, and a project up in Morningside Heights. Briefly, I agree with a lot of the sentiments that Shimon was discussing in our world in development. We're definitely seeing, a landscape that exists of, grandfathered large-scale 421A sites, newer sites that didn't qualify that, have to be either chopped up or focusing on smaller deals, and then the whole world of conversions, which is sort of like the new, kind of a belle of the ball, I think, right now, and I'm sure we'll have more time to talk about it.
Tom Ortinau from GFP Real Estate. I have the pleasure of working for the Grau family. They're a long-term family owner in New York City, been around for about 70 years. My role at the firm is to help them expand their portfolio through new projects, mostly acquisitions, but I work on development as well. I've been there for about 12 years. We're opportunistic. We do a lot of things, office, industrial. We did a lab building in Long Island City a couple of years ago that's been very successful. We're pretty active in the residential space right now. That's a sector where we have the most conviction and a decent amount of opportunity. I'm sure I'll talk about that as well. As Shimon mentioned, we're involved in we played a role in the negotiation, sort of providing feedback to the city and the state when they were putting together the 467M program. Happy to talk about that later as well.
Thank you. Meredith?
Good morning. I'm Meredith Marshall. I'm a managing partner and co-founder of BRP Companies. We're a fully integrated owner, developer, operator in New York City. We build a lot of affordable, a lot of mixed income, and now a lot of market rate. We have about a $6 billion portfolio and another $6 billion pipeline in 5 states. Most notably Jamaica, Queens, where we built about $1.2 billion in about 2,000 units. Did a ribbon cutting with one, I think it's the best building in Jamaica last week. At least, thank you. You'll get some of the business, Shimon. You're very good. We do a lot of transformative public-private partnership projects. We're doing work with the Bronx with Hudson Companies and Jerry Kretschmer's company. We just won Site K, Hudson Yards with BXP, Boston Properties, and Monian Group. I worked with the state with the 45, not as successful as you were with the 467M, because it doesn't work in where we build Zone Cs, but I have to be careful because a lot of press are here, and I don't want to put my foot in my mouth. But I think we have to address and debate potential rent freezes, all the mandates that we have cost implications. And if you raise the price, you get less. If you don't raise the price and you can't cover costs, that's an issue. And I think if you look at the rent regulations 2019, I'm gonna get myself in trouble, and the lapse in the 421, it actually hurt the city. It actually hurt working families. And we build a lot in the outer boroughs, and there's no solution for that. And I think, one critique I have with these things, I don't see the people who are writing the legislation. I don't see the staff, and when we go up with NASAF and other groups to Albany, they give us 15 minutes. It took me 15 years to understand probably 80% of what I should know. You're not gonna get it in 15, 20 minutes. So we're underperforming the population of New York. Last point, we get the hard things right. If you look at the job growth versus housing starts, we get the hard part right. Most places, I'm in 5 states, they wish they have the job growth of New York City. We just get the housing policy wrong. And I think we have to force the policymakers to make better decisions. And I'll leave it at that.
Thank you.
Hi, my name is Jesse Hutcher, founder and managing partner at Derby Copeland Capital. We are a very opportunistic lender, investor in New York City real estate. I saw at least 8 or 9 of our deals up there during Shimon's presentation. So the ones that we didn't do, I'm a little disappointed in ourselves. But we pride ourselves on having a diverse offering of products everywhere from ground-up construction lending, longer-term 5-year financing options, secondaries, mezz, pref, you name it, we'll look at it. And we just raised a new fund to put about $1.2 billion to work across the city over the next 3 to 5 years, depending on project volume. So we're going to be really aggressive in pursuing these deals and helping provide some of this affordable housing, especially through these new programs. So looking forward to talking more through that.
Thank you. Appreciate the introduction, gentlemen. Let's jump right into kind of the federal budget bill that was passed that Shimon referenced here. And Meredith, maybe we'll kind of start based on the comments that you made about the job growth and kind of the zoning issue, that we don't get that piece right. And then embedded in that bill, we have the low-income tax credits and the effects of that. And wanted to kind of get your thoughts from that, and then we'll open it up to the rest of the panel.
So you want me to talk about the big, beautiful bill?
I refer to it as the new federal budget.
No, okay, I'll just touch upon 2 things. The easy ones first. The 9% credit was, I think, increased by 12%. 9% credits are good. They're very competitive. They cover about it used to be 60, 70% of the cost of a very low income development using the 9% credits. What's more prolific is the 4% tax credit. And you had this, I think, an esoteric feature where you had to cover 50% of the cost of development. Land and construction had to be allocated towards the bonds. And now they relaxed that to 25%. So you can get more bond cap and more deals. And we do a lot of, some people call it fake affordable. I don't call it fake affordable, but it's 25% of the units below 50% of AMI. And we condoed out the tax credit portion. We can do a lot of that now. And that legislation was sort of, I think, lobbied for a dozen years, and they came through. On the flip side, though, is the reduction in Section 8 that's proposed by HUD, which sort of, they help you on one hand, and on the other hand, low-income tenants are really, really helped by rent subsidies. And in this country, only 25% of the population that qualifies for Section 8 actually receives Section 8 benefits. So, the critique is we need the Section 8 should be enhanced, and I think it should be double or triple, because it's an elegant way to get developers to build, because you're going to have support at the lower income levels.
The green energy initiative component of that, how do you factor that in? You cover the Section 8, but
I think that they're pulling that back, aren't they? Right. So we had a project that had $15 million through CPC, the Green Energy Initiatives, that we have to replace with, private private equity and private debt. Or in this case, I think we have something from another not-for-profit. But we use all the tricks in our developments. Brownfield tax credits. We had a deal in Jamaica, Queens, our first deal. We had 11 sources of capital, and if you take something away, you have to fill the gap. And folks, I used to have an afro when I started this stuff. Shimon also, right? We had afros. You pull your hair out. You get that. You pull your hair out trying to fill the gap. So if you take something away, something else has to replace it. There's no free lunch in our business. So I hope that something could ameliorate what's been happening. But we use green energy credits a lot, and a lot of our buildings are designed 100% electric. Particularly we're spending a lot of time in Westchester outside of New York City now, because other people, for example, we have a deal in Atlanta. We've created, I'm giving it away, our competitive advantage. We created a synthetic 421A, and the folks say, so we can just give you zoning and as a right tax credit, and you could build more? We want this stuff. What we're taking away in New York, what we had right in New York, the as of right features, other municipalities now are offering the same thing that we created, 50 years ago. So I think, we have these additions like the, reduction, in the bond test and the 9%, but at the same time, you're taking away Section 8 benefits. It doesn't really add up. So I think it's a net negative. Maybe it'll be addressed, when Congress comes back. But I think that's an issue. When you take away the green credits, you just take away another source that we have to find elsewhere.
Got it. Thank you for that. Justin, over to you for your thoughts on the budget.
Sorry. I think when you step away from some of the affordable stuff, some of the benefits that was added to the budget, obviously the 100% depreciation that was brought, that a lot of people are going to be looking to take advantage of, and hopefully that'll, draw more capital into the real estate sector. Making opportunity zones permanent, I think, will lead to more investments. We're in the Gowanus section of Brooklyn on the east side of the canal. That's an entire opportunity zone. We're building 1,200 units that are all structured and are either open or actively getting built under opportunity zone. That was a big aspect of creating that sort of liquidity in the market. I think that it's yet to be seen, depending on where the new census tracts end up laying out, how much some of that opportunity zone capital ends up moving into the market, because those aren't going to happen until 2027. So those are for new projects in 2027. Right now you can continue investing in opportunity zones. The benefit of the opportunity zone is not that strong right now. The deferment only goes to 2026, so there's essentially no deferment left. There's no step up in basis. So a lot of the benefits and a lot of the liquidity that we saw of opportunity zones was really during that 2020. 2019 to 2022 time period, especially when you had the crazy rise in the stock market, because there was so much gains being realized and people finally had an opportunity to do something with them. You're not seeing it as much right now, but I think that depending on how those censuses shake out and whether or not people are still looking for the 10-year hold tax benefit, which is still there, and they're okay leaving off the deferment and the step up, that might be something that's very attractive.
It's a beautiful project there in the Gowanus. So I grew up a couple of blocks from there. I don't know if anyone could tell from my accent that I'm from Brooklyn, and that it's getting stronger as I'm getting older. But thank you for that. Tom, over to you.
Yeah, we don't work as much with subsidy in our projects as some of the other folks. So we don't really pursue opportunity zones as a kind of a purpose strategy. So I don't really have that much to add, aside from the fact that obviously it's really tough when you take away Section 8, putting aside sort of the policy hat, when folks are relying on that to pay their rent and then it goes away. It's really, really rough on, I'm sure, the tenants as well as the landlords. So I would hope that there would be a better solution there at some point. Opportunity zones, yeah, I think it's probably going to help bring liquidity to projects in those locations. We don't purposely pursue projects because of that, but I'm sure it'll help bring more projects.
Thank you for that. Jesse?
Yeah, I think tying to the opportunity zone side, while we're not directly involved with many of those projects, it's always interesting to see that most of the previous funding from the opportunity zones actually flowed into New York. I don't believe any other place was as large of a beneficiary. So I think it's great that there'll be continued investment in New York, I'd imagine, on the opportunity zone side. I think as a lender, the one thing I look at when I see that bill is it makes it harder for me to believe that lower rates are feasible in the near term, given the just basically the general direction of the budget and everything that could drive inflation behind that. So I think from our view, it probably expands the need for more private credit, just to kind of fill in those gaps. And I think it changes how we underwrite in terms of long-term projections on takeouts, and maybe how we see cap rates just relative to higher interest rates for longer. So, I think that's really the piece we're most focused on.
Great, thank you for that. I'm going to shift a little bit, Tom and Jesse, to office to residential conversion. And Tom, you were part of Coffee and Cap Rates about 2 years ago, and I think you were just starting 25 water at the time. Be great to hear an update on that project and what you have going on in that space.
Sure. Yeah, happy to talk about it. Yeah, 25 Water is a project that we're really proud of. It's a project, it's kind of an effort that we started in probably 2021. We closed at the end of 22. It's a fairly large project. It's about an $850 million investment, about 1,320 apartments. It was one of the first projects to opt into the 467M program. And yeah, it's been a great experience. We worked with Nathan Berman from Metro Loft. He had a lot of, he's been doing that for a long time. So he brought a lot of good ideas and IP to the table. And it's been great. I think Shimon asked me to talk about some of the things we learned about that. We had the, I guess, the benefit of having diligence that project for about a year and a half before we closed. So, and we're pretty careful people, so we spent a lot of time trying to understand the building and had pretty tight kind of understanding of it before we started the project. So we had uncovered a lot of the things. There were certainly known unknowns, like how much asbestos was in the building. You just don't know until you open it up. But there weren't that many surprises from like a execution standpoint. The one big thing that happened in the project is the 467M program. We didn't plan on it. We planned on it being a 100% market rate apartment building. So we did opt the building in. We probably would have designed the building slightly differently if we knew that we were going to do that, but that's totally fine. So that's been kind of an unexpected change in the project. But yeah, overall, we're very happy with it. We're in the process of refinancing at the moment. And we're taking what we learned from that project and applying it to new projects as well. So it's been great.
Terrific. Glad. Thank you for that. Jesse, any comments on office to resi?
Yeah, I think for us, one of the interesting things about being a lender and seeing these projects is there are a lot of different angles and a lot of different strategies being deployed. Also, what we found is most people will typically want to bridge, take 6 months to a year, really kind of figure out, definitely on a new acquisition, figure out what their plan is. And I think some people won't necessarily be honest with their lender and say, hey, we actually don't know what we're going to do with this, if we're going to try and enlarge a building, or if we're going to opt into 467M, or if we're going to really just try and pursue a free market strategy, which is fine, because candidly, I think what's great about some of these deals is they're being either they're distressed short sales, which with reset bases, and I think people are buying these well. I think what I found is, at least on the earliest of these bridge deals we did, it seems like fewer people are going to opt into the affordable program because they struggle with the AMI bands. I think some of the earlier ones we're doing are not going to end up being affordable, but we're seeing some of these larger deals now that I think you'll see close over the next couple of weeks, where you'll see a series of affordable projects announced, and they're going to be heavier on smaller unit types. So I found that a lot of people seem to think that might be the path forward with the affordable.
Great. Let's close out. Anything that we want to discuss, Meredith, Justin, around 421A, 485, 467, anything that we missed here, and your thoughts on that?
I mean, I think that what you are seeing with 420 and 45X is just how powerful, thoughtful legislation actually is. I use the example of 175 3rd Street because that's a recent acquisition for us, and it's going to generate 1,100 units. 25% are going to be deeply, permanently affordable, right? So 60% AMI and permanent. That's a transaction that should have sold 2 years ago. Okay, that site had a pile on the ground. It could have been built under 421A, but nobody was willing to take the risk, and no lender was going to finance that with the assumption that you were going to be able to complete it by 2026, right? Like that just wasn't going to happen. So you had a site here, which is one of the best sites in Brooklyn, right? And it's large, it's scalable, it's going to generate a ton of housing, and it's just sitting there. And nothing can be done with it because, Albany is, trying to figure out how to kind of create a program that is somehow, perfectly aligned with, giving everybody kind of what they want. And sometimes when everybody gets a little bit of what they want, everybody kind of gets nothing, right? So that's a site that this, Governor Hochul overlaid, that area with a state level abatement that kind of unleashed a lot of financing, but it was taking time for it to be final. And then after the 2 years where nothing was getting done, they finally extend it, and boom, they extend it, site trades, and now excavation is starting next week, right? This is a site that probably would be 6 to 12 months away from opening right now, and it's not. And it's going to be amazing, and it's going to create a lot of housing. But that I think is what you see when legislation is held up. You actually see tangible things traded there. So.
I think just, is it Justin? You just made the point. Gowanus was sort of grandfathered, right? But then we're left in Jamaica, Queens, and Harlem, and central Brooklyn with the new 485 that's worse than the old 421A. So we made it worse. And the uncertainty, the reason it didn't trade, because you had to complete those sites in 2026. Lenders and equity investors will say, look, what if you complete it in 2027? I have basically regulatory risk exposure. So I think the politics actually screwed it up. And it's just not the investors. It's the architects, the engineers, the construction workers, the title company. No one could rely on a predictable regime because we didn't know what we were going to get in Albany. So, and Mark, you could attest to this. We tried to help in the 485, and I think it was a suboptimal process because, as you mentioned, they're trying to satisfy all these different interests, and you can't do that. So we had something that worked, and we made it worse. Everybody's saying, well, let's wait and see. Well, if you do the math, it doesn't work. So things are getting more expensive, interest rates are higher, and that impairs value even more so. And look at the rent stabilization numbers, right? Look what happened after 2019. You mentioned a 50% impairment in value. Where does that leave us, right? I have buildings now that, it should be cash flow, it's negative cash flow. And my partners say, their property again. So we actually write checks to cover, and these are smaller buildings. Obviously, the larger buildings are better, but we have to fix this thing. We have to go back and look at the legislation and own up and say, okay, it wasn't the best thing. Let's take I do it all the time in my house. My wife and kids tell me I'm wrong all the time. And I go, I have to make a better decision next time. Why can't we do that with bad legislation, right? I don't understand it, right? The data is very powerful. And you make a compelling case that we should bring you to Albany. I'm serious, because it's just when you see the values, and mom and pops, those small buildings, the big fat cats don't own those things. They think they're hurting, the guys who are big. They're not, right? It's really mom and pops and small operators, folks who got in the game, and they don't have a management staff. They manage their own buildings. They're hurt. So I think we should sort of get together and maybe try to fix these things from 2019 on up until 45.
Okay, Shimon, we have a takeaway here. That's all right. We definitely have a follow-up. So at this point, I'm going to kind of channel a little bit of Michael Stoll. The one thing that I loved about his program was he had a crystal apple, and he would do looking into the future, right? He would talk to the apple and say, okay, what's the future going to bring around interest rates, around just whatever the topic of the moment was. And I love that, and I will always remember the crystal apple. I got to get one for my office for sure. But I'm going to ask you about that, opportunities, the future. What does it bring? New York City, the metro, across the country, in kind of how you're thinking about your business. Meredith talked about kind of taking concepts that we honed here and now applying them in other locations. Really want to kind of get your thoughts around asset class. It's a long question. Affordable housing, development, but really from a future perspective, I think the interns will benefit from that wisdom that you'll share with us. What do you find attractive, Tom? Also from an office perspective, want to hear about that. So maybe you could lead us off.
Sure, thanks. Yeah, the great thing about New York, the thing I love about it is it's a very dynamic place. I'm sure a lot of people here appreciate that. So it's also over liquid. There's a lot of capital that wants to invest here. So there's a lot of folks that are, making deals. Sometimes they get into trouble. We try to be sort of a trusted, comfortable counterparty that people can bring in to help clean up some messes that happen sometimes. As it relates to what asset classes, we're spending most of our time in the residential space. I don't have to explain. So Shimon was very articulate in showing, why rents are going up and why values are going up. We're comfortable with that dynamic. So both in the city as well as in Jersey. So I think we're going to be doing that for the next few years. The office sector is a very dynamic sector as well. Shimon is totally right. The A space is doing the best. The B space has been suffering. The B space is where the Growls, who I work for, own a lot of property, so we understand that sort of sector pretty well. It's still very difficult to invest in that sector, but at some point, I mean, the sector is improving. Like if you have a really great avenue building, a good landlord that, I think the Growls are thought of as being a pretty, a landlord that leasing folks are comfortable bringing their customers to. There will be a moment where we're probably more comfortable investing in that sector. It's just been hard, mostly just because the rents have been down and concessions have been pretty high. So, but we look in other things too. We like the industrial market. It's been a little bit slow. I talked to an industrial broker yesterday. He said it's still been sort of sideways, but we'll track that. Life science has been tough. I think we built one of the only buildings that really got leased well. We're going to continue tracking that. Really anything that relies on venture capital to drive tenant leasing. So the tech sector, life science has been tough. Since the interest rates blew out, VC has been really taking a nap, let's just say. But we'll continue tracking that. It's a place that long term we think there will be opportunity. Long way of saying we like to remain opportunistic. We have our eyes open. We're careful folks, so we try to pick our spots when we're really just very comfortable, and we'll be there when there's opportunity to pursue.
Thank you, Tom. Jesse?
There's a number of asset types that we're definitely excited about. I'd say some of the projects that are the most exciting to us are some of these adaptive reuses and these conversions of really, for example, a deal we're working on in Williamsburg that had an industrial component, industrial office that's being converted to residential, being enlarged, and it's going to be a great residential project with retail, and it's exciting to see buildings that large get transformed. There's some exciting condominium projects we're working on. So I think we see a mix of everything. So honestly, I get excited about everything from a small value add multifamily deal in Chelsea to a larger condo development. But I think everything falls into the multifamily category. I'm excited to see more liquidity, I think, entering the debt space for office, because I've seen a number of good office deals over the last few years, and part of the reason that I haven't wanted to transact is really the capital ultimately behind lenders, right, and where that leverage is. And what I've found is there's more and more groups willing to provide that back leverage. So I think you could see more competitive pricing on office. So hopefully that provides somewhat of a reset. And then I also think the liquidity on the office can come in because you have some lenders who can, and some equity investors as well, who I think can kind of treat maybe a B or C building as more of a covered land play with in-place cash flow in the short term. And if they have a conversion option down the road, because either the basis they're entering into is attractive enough on a reset that it works, or they just have long-term capital, that makes sense. So I think that's just going to increase deal flow. But otherwise, we're very excited about New York. We think the underlying fundamentals are great. You just don't have leasing velocity on residential properties like this anywhere else in the country. The vacancy rate is incredibly low. I feel like people have rung the death knell for us multiple times. 2019, good cause eviction, COVID. And I feel like the market continues to remain strong. Obviously, there's problems that we've all addressed and room for improvement. But I remain a long-term believer in the city, and I think we're excited about what we're seeing.
Same. The job creation piece that Meredith spoke about really resonated for me. Justin, the crystal ball, the crystal apple, I should say.
For us, it's mostly just going to be residential. We're not touching office, at least office for the purpose of being used as office. New York City needs to be building over 50,000 units a year just to keep up with demand. We are not doing that. We haven't been doing that. I'm not aware that anybody thinks we are going to be doing that. There's a lot of funky permit data just surrounding, putting piles in and things like that. When you kind of strip out all that stuff, you're just not close to it. So I think the underlying supply and demand dynamics of residential for the foreseeable future are going to be there. I think it's all just going to be a matter of like, how do you get it built, right? And depending on the neighborhood, that might look like, much more approachable condo product. It might look like, office to resi conversion product. Depending on where politics go and how much, liquidity opens up, it might end up looking like lots of pure affordable housing. So I think the world of residential is going to continue to perform well in New York City, and that's where we're going to put our money.
And I'm going to follow that up with the next question on that. But over to you, Meredith, on your thoughts about future opportunities.
I thought I escaped that question about the future. I was sitting quiet. You got me. I haven't been around for these cycles. You see, this is a weird time. A lot of uncertainty, tariff uncertainty, you have regulatory uncertainty, you have NIMBYism that's being abated a little bit, right? City of Yes, other places are saying, well, maybe we should open up a little bit. And I see convergence of, because I was in a world, I was a market rate guy. People think we started affordable. We got affordable with the Great Recession. I didn't know what a tax credit was until 2007. And then we became masters of tax credits. And now we're doing more mixed income where it has a private equity profile. But because we know the affordable stuff, we have a competitive advantage, right? And I see that everywhere. We're in 5 states. I'm running up 2,000 units, and everything looks the same, right? The newer units, well located, amenity-rich buildings, we're renting up like 10, 20%, better than underwritten rents. And we're getting sort of a mix, the demographic mix is spot on. Where we have the problem, believe it or not, is the 100% affordable. Because you have all these constraints. It has to be 40% of AMI, 60% of AMI. You can't make $1 more. Oh, you got a bonus, you don't qualify. That's harder to do. And I'm gonna give this away. We did 3 projects in Jamaica, Queens. One was 100% affordable, pretty much reaching the same income levels, a third low, third moderate, third market rate. And we used an opportunity zone. We had a $300 million investor, pure equity. We put in $15 million of our own money, no debt. And we did the third project. We got a $200 million loan from AIG, and we got $140 million in equity, 70 from a sovereign wealth fund that I'll disappear if I mention who they were. I shouldn't say this, but the easiest transactions were the private equity transactions and the OZ transaction. The city funded transaction, we had 11 different sources of capital. We had state demolition grants, we had low income tax credits, we had Brownsfield tax credits, all these restrictions. That project was 15% more expensive than the other. When you have negative amortization, all those things that all the housing nerds know, that's actually more expensive, right? Even the construction was $400 a foot, and I got it down to $325 for the other because I didn't have all the constraints. And we looked at that, and I brought the policymakers and maybe we're getting it wrong. Maybe we should subsidize the rent, stabilize stuff at 1%, subsidies, and make that permanently affordable, because look at the acquisition cost. And when you look at the cost to build a new unit in New York affordable, it's $700,000, right? Why would you do that? So I think what's happening now, convergence, you bring in private equity, we have BlackRock, we used to have Goldman Sachs Urban Investment Group. I have 3 private equity investors now in our deals, and they're starting to figure it out, and I see that being a good thing. I mean, because they realize you can make money, you can do well, so it's almost triple bottom line, you can build new and green, but you could help solve a big problem. And I'll leave it at this. We need 300,000 units. You said 5, we're building about 30,000. We need to build another 30,000. We're not gonna be able to do that unless we reimagine our pipeline and really leverage the resources we have just in this room.
Thank you for that. I think that's so impactful because the number's 500,000. I'm looking at Red Hook. There is the Brooklyn Marine Terminal project that's being discussed. And someone shared with me a statistic that in that sub-market, they've actually lost. They're in a deficit affordable housing unit space. They're actually being taken away. They're losing those sites. So a lot to get after on that. I'll use this moment as kind of closing remarks. We'll kind of go down the line here around that theme and what Meredith was talking about and talking to policymakers and what we need to do. I wanted to close on that and see your thoughts around how do we tackle this issue, because with the job growth, we need housing.
Yeah, I think a lot of times people look at particular problems and they try to think of like a very specific silver bullet as to the solution, when in reality there's a whole host of things that can be implemented that kind of tackle the issue every which way. I think, generally speaking, I think that this city needs to put housing above politics. So they need to say, we need more housing. It's going to come in all different shapes and sizes. Some is going to be luxury, some of it's going to be affordable, some of it's going to be conversion, some of it will be ADUs, some of it will be micro units. And by the way, you're not all going to be happy with every single type of housing product that we build, okay? But increasing the amount of housing, reducing the cost of living, and generating that supply is more important than your kind of perfect little policy that you are kind of trying to solve for. Some of it might have union labor, some of it might not have union labor, right? So the second that politicians stop caring about all the minutia of the bill and only focus on policies that do one thing and one thing only, which is generate more housing, that's when we'll get it. I don't know that the politics are even close to being able to do that, but that's what they need to do. And I hope that in the future, people start thinking like that.
Thank you. Tom?
Sure. Well, I agree with a lot of what's been said. I think a lot of credit should go to the governor and the mayor, who have actually done a lot, I think, to try and come up with a lot of good ideas. City of Yes was great. The 467M program. I mean, these programs came together relatively quickly. They really wanted to sort of work with REBNY and figure out a model that worked, and I think we did that in 467M. There's been some commentary for sure about 485X not being a perfect program, but I think it's great that they were able to revive it and actually have incentives that actually help housing get started again. I'm sure they'll, in 3 years they'll redo it again. But I think the mayor's done a lot to not only help be creative around housing production, but also policing and public safety and all those things. Serious crime is down a lot, is my understanding. I feel the city's getting vibrant again, and there's a lot of good things happening. So it's beyond just sort of the housing programs. I think it's also just running the city, and I think a lot of credits should be due to the folks that are running the city right now.
Watershed moment here. Jess, over to you.
Yeah, I think we've covered a lot of so I won't necessarily harp on it again, but I think one kind of smaller thing that I see a lot as a lender on some of the conversions in particular is, and it's somewhat more of a simpler thing that I think the city could tackle, is with rates being as high as they are, and I think one thing that would be really helpful for getting more deals done would be figuring out a way to expedite Alt 1 approvals, because even in a vacant property where it's a small building, you could see from our vantage point something have to get resubmitted multiple times on something that appears to be a relatively simple project. It could take a year, and that carry cost with even if interest rates were say 50, 75 basis points lower, it kills a lot of these projects. So, I see developers and borrowers struggling with that. So to me, that's just something that seems more manageable. I'd like to see if there's a way to basically expedite approvals on projects like that and sign-offs, because I think that could create a lot more housing fairly quickly.
Thank you for that. Meredith, you get
Yeah.
closing remarks.
I just think we're at a point where we need different tools, and sort of the market rate developments in the future will have to really reduce the cost of construction. And I think, being trained as an engineer, I think we have technologies, and we'll talk to someone here about modular technologies to build, regular, run-of-the-mill studios, ones and twos, and then bring down the cost, because I just don't see how can we have a robust future if, we go from, 600,000 a unit to 700,000 a unit, 800,000 a unit. How do you subsidize that, even with incentives? I mean, we're building some units $100 a foot, or even more in Site K in Lower Manhattan. Downtown Brooklyn, maybe 80. But other places, you're not going to see that rent growth because you don't have demand that's wide enough, because owing to, incomes are constrained. So I think we have to reimagine how we look at this and try to support maybe some R&D, maybe relaxed regulation to actually bring different tools into the fore, because I just don't see how you have your OpEx growth, right? Insurance and all those things are up. You can't freeze that, right? So you're going to have to sort of bring down the cost somewhere else, and I think it's just the cost of construction. 20 years ago, we were building with Joy Construction $150 a foot, and now we're $400 a foot. You remember those days, right? It was $160. We go, can you squeeze the number? And that wasn't too long ago. That was 2005. I guess that was a long time ago. My kids are right. But now it's $400, $425 a foot. It just keeps going up 5% a year. At some point, it's a breaking point, right? And I think that is what we're gonna have to focus on. So I like what you said about the mayor and the governor. It's actually getting better, right? I'm seeing more term sheets. I'm seeing better policy, but the weak points are there, and it's basically how do you sort of, reduce the cost curve? And I think we should focus on that, but I'm feeling good. Like I say, I'm seeing more term sheets. I think we'll close on 6 deals in the next 12 months, major deals, and the equity there, I'm seeing debt term sheets. I'm seeing more people coming into the market. So, I'm hopeful. I have to be optimistic because we sign personal guarantees, right? I'll be suicidal. But, I'm encouraged. I'm encouraged with this meeting, and I think folks is finally getting it right. I think NIMBYism is there, but it's weakened. And I just think we're gonna have a better future as long as interest rates come down a little bit, and we bring more sanity into our policymaking efforts.
Perfect. Thank you for that. Thank you for closing out such a wonderful, compelling conversation with the four of you. Let's round of applause for this amazing panel. And thank you all for attending. This has been a very special Coffee and Cap Rate for us, and I think maybe policy and something will be our next maybe venture into gathering us all together. So thank you for an insightful and a really deep conversation.